Why shouldn't I be in 100% growth? There's a bit of noise around this in the various Facebook groups and Reddit that I follow. So when most people think about growth assets, they think often about the major equity markets around the world. So much of that chatter is, what does a high growth portfolio look like? And our big super funds are complicit in this confusion that growth, if you recall the 5 Bs of investing, the defensive asset classes are bills, bonds, and bullion, and the growth ones are bricks and businesses. That is, bricks being real estate and infrastructure, and businesses being shares. But shares covers quite a lot. And so when people think about 100% growth portfolio, they often mean 100% large cap developed markets. And our super funds fit right into this narrative by offering very cheap indexed large company offerings. So you can buy a 100% Australian equities, which tracks an index that looks largely like the ASX 200. So it consists of companies that fit in that top 200 to 300 by market cap. So they are by any measure large companies. And similarly, when you look at global shares, they tend to be looking at the MSCI large cap companies, because these are cheap to manage. So you can buy an Australian indexed fund, outside super, it's a thing like VAS or IOZ or A200 for close to zero management fee, something like 4 to 7 basis points. That's 0.04%. So on $100,000 investment, that's $40. Like, it's just close to zero. And that is clearly a 100% growth portfolio. And if you simply add 10% of bonds to that to create a 90%, you will end up with, on average, a lower return. You will gain a lower volatility, but you will have to give up some return to do that. But not all shares are created equal. So within shares, if you go back to modern portfolio theory, the efficient market, the capital asset pricing model, and the factors, there are 3 broad factors that drive returns in shares. So generally, big companies underperform small companies. And that's largely because small companies are riskier. So you should expect to get a higher reward for it. And because it's much easier for the management of a small company to double, triple, quadruple its value. Whereas if you're running BHP or NAB or CBA, it's pretty hard to double the size of the business. And so small companies, on average, outperform big companies. So by allocating some of that 100% equity, large cap equity allocation to small companies, you would expect to get a higher return. And so that's one way to increase the return to compensate for a little bit of defensiveness. So you can, in that context, similarly, the second factor is the value growth factor. That is what multiple of today's earnings you're paying for the company. And in recent times, we've been very much a growth market. So the so-called Magnificent Seven, Facebook, Google, Alphabet, Google, Amazon, Netflix, Nvidia, they're all growth companies. So you're buying those on a very high multiple of today's price, which is all good whilst they continue to deliver the growth rate that the market expects. But as soon as they fail to do so, and we saw this with NVIDIA in its latest quarterly returns, that the market punishes them mercilessly for that. So massive falls in NVIDIA's share price after at least its most recent quarter. And so the reason value companies outperform growth companies is that you're paying less for the same set of cash flows. And so all other things being equal, value stocks outperform. And that's Warren Buffett's bread and butter. So the reason Warren Buffett is has the investing track record that he does is because he's been looking for value companies. Now, they don't all outperform all of the time, and they do for long periods of time underperform. But on average, over time, value stocks outperform growth stocks. Not been true for the last 3 to 5 years, but over time, that's what the evidence shows. And then the third factor is profitability. So profitable companies, surprise, surprise, outperform unprofitable companies over time. Now, not all of these factors will deliver every time, and not all will deliver at the same time. But by reallocating some of your growth allocation to different factors within the equity portion of your portfolio, you can drive up your returns. And so that's why 100% large cap equities is rarely the right answer. Now, once you've added in all those things, you will get something that's different to the market. Sometimes it will be different bad, and sometimes it will be different good. But over time, you can expect it to outperform. Adding small cap value, generally, well, especially in Australia, generally means finding a active manager, which obviously increases your cost to manage it. But small cap funds are generally more expensive to manage. So you will increase your cost to manage. And so you're not going to buy an active small cap value fund for 0.07%. You'll more likely be paying potentially 1%. But if you can get your overall cost to around the 0.4 mark by the time you add in some small cap, some infrastructure, some real estate, and some other factors so that you can do that. You can then afford to add a little bit of leavening from defensive stocks, or defensive assets like bonds or gold, and that will then lower the overall volatility. So you can construct a factor-based portfolio at the 90% growth level that will outperform, on average, a 100% large cap equity portfolio. And this is the bit that the Reddit tech bros miss, that you need a lot of growth. There's no question about that. The younger you are and the longer your investing horizon, the more growth you should have. But growth is not synonymous with large cap equities. And so we need to look at the various factors that create that return. And large cap is one of those factors. And we do know that, and certainly should be the core of your portfolio. But we do know that small companies outperform big companies, value companies outperform growth companies, and profitable companies outperform non-profitable companies over time, on average. And by building your portfolio with all of those factors in mind, it doesn't play very well as a clickbaity title on a Instagram feed, but it's what the evidence shows, and that's what you've got to focus on. Investing is no place for ideology or prejudice or urban myths. It's a place for evidence, and that's what we need to look at. So that's really the key to it. And I must admit, I'm over arguing the toss on Reddit on this one. I will let the evidence speak for itself. And certainly the Life Sherpa 90% growth portfolio, that's our high growth portfolio, has outperformed a 50-50 blend of Australian international large cap stocks over the last 20 years. So the evidence speaks for itself.